Welcome to the latest Motley Fool scoreboard. I'm on in Chocolate Blue, and we've got longtime fools Jason Hall and Matt Frankel giving a 1 to 10 rating to Jason Hall's favorite stock. At least at the time I asked all the panelists for that snazzy biographic, and we did confirm before taping it's still his favorite. It's Confluent, ticker symbol CFLT, and we did the pronunciation too. It's not Confluent as I would wanting to call it. It's Confluent.
Anand, you nailed it. I want to say you pronounced Confluent better than you pronounced your own last name in the intro here. Just want to get that out there.
You know, I mess up my last name a little too. A lot of syllables. Not just everyone else. Talk about the business first, including factors like industry and competition. A 10 is invincible and a 1 is hopeless. Matt's at a 7. Jason's just a little higher at a 7.5.
Yeah, the business quality is good. And the reason this is a little lower than I've ranked it in the past is, and this is a case where a lot of times when competition gets thrown out there, it's just kind of lazy analysis, but it is a massive reality in data streaming. And that includes the hyperscaler giants with the cloud infrastructure that Confluent is frenemies with, because they all have proprietary streaming products as well. And there's lots of other companies that are involved in data that are bringing streaming products to the market. But here's what I always come back to. These are the people that essentially help create data streaming as a category. And their off-the-shelf product, the Confluent Cloud product, is built on Apache Kafka, which is the open source tech that they literally created.
Yeah, They offer some very critical tools for businesses, but I gave it a 7 mainly because of that competition that you mentioned. They compete with AWS, with Microsoft, with Alphabet. I mean, these are very, very deep-pocketed competitors and that have significant momentum themselves. So that's why I didn't give it a higher ranking.
For management, a 10 is Warren Buffett, a 1 is Homer Simpson. When you got a lot of competition, you've got to trust management. Matt's at a 9 and Jason's at an 8.
Yeah, so you got Jay Kreps, the CEO. And a lot of times we see CEO founders that don't necessarily turn out to be the right person to lead the company to profitable growth. I think Kreps has done a great job. He is a visionary. He's also a great spokesman for data streaming for the industry. Jun Rao's an executive with the company too, and also a co-founder, and is deeply, deeply involved with the open source data streaming community. We actually have a third co-founder, Neha Narkid, who's on the board, was an executive at the company from the time that they founded it until only a few years ago. And then she stepped down as an executive, has remained on the board. You also have a lot of insider ownership. I'd love to go higher than an 8 here, but I'm going to ding management for stock-based compensation. Like 39% of revenue over the past 4 quarters. So a lot of the value that management is creating is not flowing into the per share value for external shareholders so far.
Yeah, I gave it a 9. And to be fair, I included stock-based comp in my financial score. So I'm not letting them off the hook. I'm known as the stock-based compensation police around here. And I'm not changing that for this company. But the co-founder is an impressive person. Can't really blame him that the stock hasn't delivered great returns in its publicly traded history, because it couldn't have timed the IPO worse. It was mid-2021. But Jun Rao, the other co-founder that you mentioned, he's the one who actually founded that, or he created that Apache Kafka architecture. So you're really impressive leadership team, but a great job of innovating, growing subscription revenue. And you mentioned the high insider ownership. Jay Kreps owns about 6.8% of the company.
It has a higher voting share too, because of the share structure that they have. And I would counter your argument that they couldn't have timed the IPO worse. They couldn't have timed it better in terms of generating cash
of the stock price performance.
Right. Those of us who bought close to the IPO couldn't have bought at a worse time.
Fair.
I think that's the thing. So there's 2 different parties involved when it comes to that. I'll talk more about that later. Go ahead, Anand.
No, very good point. Let's talk about financials. A 10 is a fortress. A 1 is yikes. This is where Matt promises to factor some stuff in. He's got a 6, and Jason's a little higher at a 7.
Yeah, so my 7, again, same thing. I'm also factoring in stock-based compensation. the things that the company gets rewarded for is that gross margins have steadily moved up and to the right. And a lot of times in competitive situations, margins don't improve. You're having to fight over price. It's harder and harder to win deals and continue to grow margins. And those gross margins have steadily grown. Revenue growth is slow, but it's been really, really consistent. The business is unprofitable on a GAAP and an adjusted basis, but it's breached the cash flow positive threshold. And that takes pressure off of the balance sheet, which is relatively strong. I'm going to circle back to stock-based compensation. Like I said before, it made up 39% of revenue over the past 4 quarters. Now, circling back to the IPO, yeah, it was a terribly unsuccessful IPO for IPO buyers who bought when the stock debuted. But the reason stock-based compensation is so high because the company went public like 3 years before they were even planning to do it. So we're continuing to be punished by that pre-IPO comp plan where insiders get a lot of stock-based compensation because you're working for a startup. So we're having to still kind of pay the price right now.
Yeah, and I mean, a 6 is about as high as I can justify giving a company with that level of stock-based comp. They do have about $800 million of net cash on the balance sheet. So even though they're not profitable quite yet, at least on a non-adjusted basis, because of that stock-based comp, they do have plenty of growth runway to fund what they're doing. The profitability is moving in the right direction. I'll give it that, but it's not quite where I'd like to see it at this stage of the game.
Jason, let's move on to valuation. How well will Confluent stock do over the next 5 years? How safe is it? 10's a sure thing. 1's a lottery ticket.
So I think we're primed for 15% plus returns over the next 5 years, and an extremely volatile ride along the way. We've already seen that from this stock over the past 5 years since it went public. My safety score is a 6. I think it's maybe cheaper than it seems. Stock-based compensation, like we said, it's going to weigh for another year or two before it starts to moderate as the company kind of gets to the end of some of those comp structures. My safety score is more about execution and competition. If you think about the valuation, it's actually a similar price to sales multiple as like some of the larger software companies. Now those are very profitable businesses, but they're also lower growth. It gets back to that increasingly crowded space and against some very well-heeled competitors that already have relationships with customers using their cloud services. But this is one of the leaders, and I think it's outcompeting against proprietary products, and it's got an off-the-shelf tool that's built on open source, which I think has value, and is there to meet customers wherever they are, whether they want to be fully managed by Confluent, whether they want to self-manage, have some sort of a hybrid environment. And it continues to grow closer and closer to being profitable and more cash generative.
Yeah, I said I was a little bit more pessimistic than Jason. I said 5-year returns in the 10 to 15% range with a safety score of 6. It's not a cheap stock, as Jason mentioned, about 8 times sales, but without consistent profitability, which I can't really give it much higher of a safety score with that. Very strong growth where it matters. Cloud revenue grew 42% year over year in a recent quarter. It's retaining well over 100% of its revenue. I do think it'll produce returns in the low double digits, but I'm hesitant to call it any more than that just because of where it's valued right now and where the path to profitability is on its journey.
Time for everyone's favorite topic. I'd be surprised if Jason has a topic, but let's see. Go ahead, Jason. Do you like any company better than Confluent in its space?
So in that data streaming space, I think it's really unique. But I think if you're just looking for an opportunity in cloud-based software as a service and in high growth areas where there is competition, but there are potentially emergent winners that maybe are getting underappreciated, I'd throw SentinelOne into that same mix in cybersecurity.
See, I said Amazon. I think AWS still has massive growth potential, and Amazon's trading kind of like a value stock right now. When you look at price to earnings and price to sales and things like that, and where it was historically. So I'd say Amazon. That's a stock that I own in my portfolio and have bought more of lately.
And to be clear, Jason, is SentinelOne an actual topic, or you're just throwing out that name as something else to consider?
Just another one to consider.
Okay. because it'd be very inconsistent to top your favorite stock. Thanks to both Jason and to Matt. They've given Confluent an overall score of 7.4 out of 10. Slightly lower than the 7.9 it got last time, but still in the same ballpark of really solid. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Starbucks. Till then, full on.